Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Hey there, and welcome to this explainer. Look, if you're in the trenches advising high net worth clients, you already know this harsh reality. Without a rock-solid, proactive tax plan, a massive chunk of a carefully built estate can just vanish, literally eaten up by preventable liabilities. Today, we're going to break down the concrete data, the strategic frameworks, and the latest legislative updates you absolutely need to know to mitigate estate and inheritance tax burdens for your clients. We'll be looking at everything from the Secure Act's massive impact on retirement accounts to the mechanics of specialized trusts, all the way to the step-up in basis. To deliver this high-density info as clearly as possible, we've organized today's briefing into the advisor's playbook. Here's our agenda. First, the estate tax landscape. Second, navigating the Secure Act. Third, trusts and lifetime gifting. Fourth, tax-free charitable strategies. And finally, number 5, the step-up in basis rules. So, let's just jump right in. Section 1, the estate tax landscape. We absolutely have to start by drawing a hard line between state estate taxes and state inheritance taxes. Federal exemption levels usually get all the fleshy headlines, right? But state laws, they are all over the map depending on where your client lived or held real estate. A state estate tax is levied directly on the overall value of the estate itself, but a state inheritance tax actually hits the specific beneficiary receiving the assets. The massive trap here is that some states have way lower exemption thresholds in the federal government, so if you haven't mapped this out with your clients, even moderate estates can get slammed with totally unexpected tax bills. And speaking of getting slammed, look at this number, 50%. It's fascinating and, frankly, deeply frustrating for clients to look at the math behind what's known as the widow's penalty. Surviving spouses frequently face a much higher federal income tax burden, usually starting the very year after their partner passes away. Even though their total household income often drops, typically because they lose that lower Social Security benefit, they're suddenly forced to switch from married filing jointly to single filer status. Boom, their standard deduction instantly drops by 50%. And it actually gets worse because the IRS, unfortunately, doesn't pause for grief. When you combine that halved standard deduction with the other items we're looking at here, the total tax rate on the surviving spouse's remaining income can just spike dramatically. Think about it. If an estate goes through probate, any income generated, stuff like stock dividends, interest, or rent, is fully taxable, and the executor has to pay it. On top of that, capital gains tax gets triggered if an asset appreciates between the date of death and the actual sale. And then you've got required minimum distributions, or RMDs, from retirement accounts just piling onto that taxable income. It's a perfect storm that easily pushes a surviving spouse into a significantly higher tax bracket. All right, let's pivot. Section 2, navigating the Secure Act. Now, we are talking about what is arguably the largest tax hit for an estate today. The crucial point here is the absolute elimination of the old stretch IRA. It used to be so great, right? Beneficiaries could stretch out lifetime payouts, easily managing their tax liability over decades. Well, the Secure Act replaced that with this brutal 10-year withdrawal rule. Now, most non-spouse beneficiaries are legally mandated to completely empty those inherited retirement accounts within a decade of the original owner's death. And because they have to pay standard income taxes on those withdrawals based on their own personal income tax brackets, this creates a massive, highly compressed tax liability. So when you compare these two paths, a Roth conversion strategy isn't just a nice-to-have option anymore. It's practically essential. By converting traditional IRAs and 401ks to Roth IRAs, your client is doing two massive things for their estate. First, by prepaying the income tax on that converted amount during their lifetime, they are actively shrinking the size of their overall taxable estate. Second, because Roth IRAs are not subject to RMDs, they leave their beneficiaries a fully tax-free inheritance. It completely shields them from that nasty 10-year income tax spike we just talked about. Moving right along, Section 3, trusts and lifetime gifting. Let's talk about a foundational move that is amazingly underutilized: the annual gift tax exclusion. For the 2026 tax year, the hard limit is exactly $19,000 per recipient. But remember, married couples can split their gifts. This means a married couple can seamlessly transfer up to $38,000 per recipient every single year, completely tax-free. It's an incredibly effective way to systematically reduce the overall size of the taxable estate without ever touching their lifetime exemption limits. Now, beyond simple cash gifting, specialized trusts are absolute heavy hitters for liquidity management and asset protection. Take the Irrevocable Life Insurance Trust, or ILIT. This completely removes assets from the taxable estate, which effectively freezes their value for estate tax purposes. Then you have the Spousal Lifetime Access Trust, or SLAT. This one executes a genuinely neat trick. One spouse makes a gift to an irrevocable trust for the other. This removes those assets from both of their estates, yet, and here's the kicker, they still retain spousal access to those funds if they ever need them. And what if you're advising business owners? Well, business succession planning is absolutely paramount. Establishing a family limited partnership, or FLP, allows your client to transfer partial shares of the business to family members. This minimizes the taxable value of the business through valuation discounts. Plus, transferring these growing assets into trusts successfully removes all future business appreciation from the taxable estate. You're locking in the value today rather than letting a booming business turn into a future tax nightmare for the family. Next up, Section 4, Tax-Free Charitable Strategies. Directing highly appreciated assets to charity is incredibly efficient, but you need the right vehicle. Let's look at the Charitable Remainder Trust, or CRT. With a CRT, your client can donate stock or real estate, get a partial tax deduction, defer capital gains taxes, and actually generate an income stream back to themselves or their beneficiaries for life or a set term before passing the remainder to the charity. It's a total win-win. On the other hand, a donor-advised fund, or DAF, acts more like a specialized giving account. Your client gets an immediate, upfront tax deduction the second they fund it, but they retain the flexibility to recommend grants to eligible charities way down the line. Now, if you have clients currently taking RMDs from traditional or inherited IRAs, executing a qualified charitable distribution, or QCD, is a brilliant move. But the execution here has to be absolutely flawless. Step 1, the client must be age 70 and a half or older. Step 2, they can transfer up to $111,000 annually, or $222,000 for a married couple. But here is the critical rule. Those funds must move directly from the IRA custodian to the qualified charity. It cannot go to a private foundation, and it cannot go to a DAF. If you execute this correctly, the transferred amount counts perfectly toward their RMDs, but it's completely excluded from their taxable income. All right, for a final section today, Section 5, Step Up in Basis Rules. You know, sometimes the best action is literally inaction. The step up in basis is arguably one of the most powerful tax provisions we have. It adjusts the cost basis of an inherited asset to its exact fair market value on the date of the previous owner's death. What does that actually mean? It means all those unrealized capital gains that accrued during the original owner's lifetime are completely erased, just wiped out. That dramatically reduces or entirely eliminates the capital gains tax a beneficiary will owe when they eventually sell the asset. Because of this, as an advisor, you constantly have to weigh the benefits of lifetime gifting against the massive tax efficiency of just holding on to appreciated assets and passing them through a will or trust to capture that step up. So that brings us to the real question. Are your clients' beneficiaries truly prepared for that 10-year Secure Act tax cliff? Look, thorough estate tax planning is ultimately about creating clarity. It ensures liquidity, avoids probate, and gives your clients control. But most importantly, it protects their loved ones from massive, unexpected liabilities during a highly emotional time. So do me a favor. Review your roster this week. Make sure your high net worth clients have a proactive strategy in place to shield their heirs from compressed income taxes, capital gains exposure, and state-level traps before it's too late. Thanks so much for joining me on this explainer, and I will see you next time.